Understanding Journals and Ledgers in Accounting. Hey there, ever wondered how the world of finance keeps track of every little transaction? Let's kick things off with a journal. What's a journal, you ask? It's the first stop for all your financial transactions, recorded chronologically. Picture this, each transaction gets its moment in the spotlight before hitting the ledger. Now, let's dive into the key features of a journal. First up, it's all about chronological order. Entries appear in the exact order they happen. But that's not all. Journals follow the double entry system. Debit equals credit. And don't forget the narration, a little explanation for each transaction. This all sets the stage for posting later to your ledger, so everything flows beautifully. Now, let's structure a journal entry. Simple, right? You start with the date, list the particulars, followed by debit and credit amounts. For example, on July 1, 2025, you bought office supplies for 500 rupees. Now, let's explore the different types of journal entries. We have simple entries, just one debit and one credit. Then, a compound entry that makes it a bit more complex with multiple debits or credits. Don't forget about opening entries, these record balances at the start of the accounting period. Adjusting entries are crucial too, for things like accruals and depreciation. And then we have closing entries to wrap up temporary accounts at the end of the period. Finally, rectification entries to fix those pesky errors you might encounter. Here are the golden rules of accounting for journal entries. Let's keep it straightforward. For real accounts, debit when an asset comes in and credit when it goes out. For personal accounts, debit the receiver and credit the giver. When it comes to nominal accounts, debit for expenses and losses, credit for income and gains. For instance, when you pay salary, that's a debit for the salary account. Time to shift gears and talk about the ledger. What's a ledger? Think of it as a collection of all individual accounts where your journal entries go. The ledger is what helps you prepare that all-important trial balance. What's the purpose of the ledger? Let's break it down. It summarizes the effects of all transactions on each account, making life so much easier. It helps you determine account balances, bringing clarity to your financial picture. And yes, it's the foundation for preparing all those financial statements. Let's take a look at a typical ledger format, often visualized as a T account. Picture it. You have your cash account laid out, with dates, particulars, and amounts. And then comes the posting process, where journal entries meet the ledger. For every journal entry, debit goes to its respective ledger and credit follows suit. For instance, when rent is paid, the rent account gets debited and cash account credited. Let's highlight the key differences between a journal and a ledger. A journal is where everything starts, the first record of transactions. On the flip side, the ledger classifies these entries by account, making it analytical. Journals list entries chronologically, while ledgers analyze them account-wise. Simply put, journals are for recording, and ledgers are for summarizing. In a nutshell, the journal sets the groundwork while the ledger builds upon it. So, there you have it, journals and ledgers, two sides of the same coin. Now that you're in the know, why not keep your financial records in check? Don't forget to like, share, and subscribe for more accounting tips to stay ahead.